Well, stocks advanced further last week into the end of the month, quarter and first half of 2024, as rebalancing flows into that period resulted in relatively choppy trade in both the foreign exchange and fixed income spaces, despite, of course, US PCE inflation continuing to cool in line with market expectations. A busy, albeit holiday-interrupted, week awaits financial markets this week as July gets underway, with three main focuses on traders' minds. Politics, as voters in the UK and France head to the polls, payrolls with the latest US jobs report due on Friday, and policy amid the ECB's annual meeting in Sintra. Plenty for myself and Ryan Littlestone to discuss on the trade-off this week. Without further ado, let's get into the show. So it was a choppy end to June for the financial markets last week and a busy start to July awaits. Helping us to navigate things, as always, is my good friend, Ryan Littlestone from Forex Flow Live and Forex Analytics. Ryan, a very good afternoon to you. I don't know about you, but my nerves and heart rate have only just about settled back down to normal after what was almost a calamitous England performance yesterday afternoon.
Yeah, I don't know about nerves and heart rate, more like my anger. I nearly kicked the TV in about 8 times during yesterday's game. So, we saved it at the last. And, let's see what we do against the clockmakers.
Well, absolutely. I can't say my expectations are high, but I'm surprised at your level of anger. I mean, as a West Ham fan, surely you must be used to this sort of dismal performance for 94 minutes and then nicking an equaliser right at the death.
Yeah, well, you see, I probably wasn't drunk enough. That's why you can't watch West Ham sober, and it's becoming the case you can't watch England sober either.
Well, absolutely. Thank goodness we play on Saturday afternoon when it's acceptable to have had a few pints. That's all I can say. Right, that's more than enough about mine and Ryan's drinking habits. Let's get on with the show into Topical Thunder. So, as I said in the intro to the show, it's a busy week up ahead and political developments are going to take centre stage on both sides of the channel. Of course, here in the UK, we're all off to the ballot box on Thursday. Well, not all of us. Some of us will have voted by post. And actually, according to some estimations, around 1 in 4 votes will have already been cast by post by the time that we get to Thursday morning. The campaign that feels like it's gone on forever is finally coming towards an end. And the result is, to be honest with you, all but a foregone conclusion. And exactly as it was 6 weeks ago when the Prime Minister called this snap general election. Labour continuing to maintain around a 20-point lead over the Tories in most opinion polls, and the Conservative Party languishing on a vote share of around 20%. Now, of course, it's not quite as simple as that, given the first past the post voting system, but I think most expectations at this point, and certainly most of the projections that you look at, points to a Labour majority within 3 figures. That certainly seems the base case at the moment. Now, what is perhaps most interesting is that the pound could not care less about the election, it would seem. Whether you look at spot cable, which hasn't really moved for a few weeks, whether you look at the options market, where there's really nothing in the way of significant expiries after the vote, either in terms of puts or in terms of calls, or if you look at implied volatilities, with 1 week cable implied vol trading around 6.4%. So that's a roughly 1 big figure range over the next 5 trading days. And that's right within the bottom 30% of where implied vols have been trading over the last 52 weeks. So as far as the market's concerned, as far as the pollsters are concerned, the election result seems a done deal. Of course, the exit poll, when it's released at 10 o'clock on Thursday night, could spring a surprise, but by and large, it seems like markets are going to take this one in their stride. So of course, Ryan, that begs the question, once the election is out of the way, focus will turn back to the macro. And I guess there's 2 really big questions that are going to dominate the UK macroeconomic backdrop as we move through the rest of summer and into the early part of autumn. The first being how on earth Labour, assuming it is a Labour government, how on earth this Labour government enact the policies that they want to bring in, given the limited fiscal headroom that we have here in the UK, and whether this 2.5% GDP growth expectation is a total pie in the sky idea. And secondly, the BOE are back in play. Of course, we discussed this last week. That decision to hold rates in June was finally balanced for some. August looks like it could be on the cards for a rate cut. And I guess that's the second question. Are the BOE now given the green light to ease policy now that political uncertainty seems like it finally may be lifting from the UK economy?
Yeah, and you've missed out the third question, which is probably comes in at number one. It's how much is the new government going to cost us? That's what we usually like to ask. Where's the first thing? Where's my taxes going?
My wallet's empty enough as it is. I don't need any more tax rises.
Yeah, well, you know what they say, can't get blood from a stone. But there you go. So, yeah, I mean, yes, maybe the market may be a little bit too complacent with the result. We as traders always need to look at where the big risk is. The big risk is that the Labour don't get a majority or as big a majority as everyone's expecting. If we do head for a hung parliament, if there's a miracle from the Conservatives or even the Reform Party, and there's no government or a hung parliament, that's going to be obviously the most negative. But given everything on paper, it's looking unlikely. How do they deal with the fiscal headroom? That's a question we're going to have to answer over the weeks ahead. Obviously, I'm not sure how quickly they'll pull together a budget. There's one thing.
Sorry to interrupt on that one. I think the Rachel Reeves, Shadow Chancellor, presumably Chancellor from Friday, has said that every budget she makes and announces will be accompanied with an OBR forecast. So they usually take about 10 weeks to produce. So, exactly. It takes them a while to work out which way the wind's blowing. So you would assume just a simple extrapolation takes you to kind of mid-September for that first budget.
Yeah, exactly. And, could that put a bit of pressure on the Bank of England not to cut rates until then, just to see what's going to come out of that? But so it's going to be a more longer term thing or more medium term thing rather than what happens over the actual election result itself. As we were chatting about just before we started the show, there's two constituencies that race to get their first results in. So those usually come in round about between 11 o'clock and midnight. We get the first results, and that can be a bit of a market mover because it gives you a very early indication of which way the votes are going to be going. It was a big mover, in fact, when we had the Brexit vote. They were the first to report. I can't remember, Newcastle or Sunderland, and Cable dropped 500 pips on the big Leave result. So, yeah, it's going to be important early hours in the morning. Then we'll get that initial reaction in the quid. I think if everything's fine, the market will be happy that we've got a majority government. That stability, the pound may have a little bit of a positive reaction to it. I don't know if it's going to be huge or not. But as far as the other policies go, yeah, it's going to be a case of wait and see what they come up with. But again, whether the BOE decide to act in August or they want to see the pounds and pence from the budget or the Labour's plans first remains to be seen.
Indeed, it does. Well, anyway, it's not just here in the UK that we have elections this week. Of course, the French have already gone to the polls once last Sunday, and they go to the polls again next Sunday for the second round of their election.
Yeah, and Sunday's first round results went pretty much exactly as the opinion polls have been showing for the last 3 weeks or so since Macron called the election. So now we have a three-way battle into the second round. During this week, there will be lots of political jockeying because if there's one thing that's certain, it's that every other party wants the RN not to win a majority. So they're all going to be at it, making deals on the sidelines. We've already had the Prime Minister Attal coming out after the vote, close to say that the RN party must be prevented from having an absolute majority. So it shows you the mood going on there. It's not a question of whether the RN party are the biggest party. It's a question of stopping them from having a majority. So that's what we're going to look out for from that side. Now, the euro dollar, it opened higher in trading Sunday night, showing that traders and investors had already sort of, made their moves on the previous opinion polls in terms of setting out their stalls for what these election results were going to bring. Mostly we saw reaction in selling of French stocks and driving French-German spreads to their highest since sort of 2017. Now, despite the market looking fairly calm, I don't think we're over that hump yet. There's still further French risk, if you take that saying, after next week's vote. While a Le Pen majority would potentially be bad in a political sense, the market may be calmed if they have a functional government. Any sort of hung parliament or stalemate would be the worst case for markets, and French assets could suffer once more. And maybe the euro has a little bit more repricing to do. But once the outcome is known, as I said, we'll need to keep an eye out for future policies and how entities like rating agencies view things, how they see things moving in France over the next weeks and months ahead.
Yeah, absolutely. I'm glad you brought that up, because I think the market reaction, and we're going to discuss this a little bit more in the next couple of segments, I know. The market reaction makes sense, but I think it may be a little bit overdone. I think the way to frame the moves that we've seen in OATs and in French equities and in the euro this morning is more of a knee-jerk relief rally rather than anything else, because, of course, the polling over the weekend, the exit polls, while they show that perhaps the National Rally, Le Pen's party, did not perform as strongly as expected, and certainly didn't win that majority that some had been concerned about, this is far from over, because, of course, the two scenarios that now appear to be on the table are either a Le Pen majority out the back of the second round, or a complete stalemate where you have nobody wanting to work with the National Rally, the left-wing alliance as the second largest party, and probably no one wanting to work with them either, and Macron's party languishing in third with no political capital with which to try and form any sort of government. So although perhaps the market's worst case scenario appears to have been avoided, I don't think that means we can all, pile in long in terms of French equities and assets more broadly, particularly when you've got this risk of the second round at the weekend. And I think if the left-wing alliance and Macron's party can't come to a deal relatively soon to pull their candidates out of seats where they finished third to avoid a sort of split anti-Le Pen vote, then the risk of a majority for the National Rally comes roaring back onto the horizon once more.
Yeah, absolutely. And then obviously after that, we have to see if all Le Pen's policies, which are a pretty hard line in talk, whether they come to fruition or whether she's going to water them down and moderate those policies a bit. There's already been some murmurs to that end as well. We saw similar in Italy with Meloni taking over the government, and then all of a sudden she's all friendly with the EU, even standing behind von der Leyen for a presidency. So it's one thing talking tough when you're not in the hot seat. It's another thing talking tough when you're in the hot seat. So that's another thing we have to look forward to should they win a majority.
Absolutely. And of course, the final piece of that, the final piece of that jigsaw is how does whoever the prime minister is work with President Macron, who is still around until 2027, whether you like it or not. Whoever is going to be heading the government is going to need to work with him somehow. So it'll be interesting to see how that relationship develops. In any case, let's move on, because it is the first Friday of the month this week, which means it is Jobs Day in the United States, everyone's favorite economic release, or the one that people love to hate at the very least, the non-farm payrolls number, and of course the associated other labour market indicators. Although I think it's going to be a little bit of a more interesting and perhaps quieter Jobs Day than usual. Of course, Thursday, July the 4th, is Independence Day in the United States. And with the jobs report coming on the Friday after Independence Day, you've got to imagine that a lot of folk will be taking a long weekend and be away from their trading desks, which is likely to result in lighter than usual trading volumes and perhaps thinner than usual liquidity around the number. Of course, that comes with two potential implications. If the figure is in line, then the market's probably not going to go anywhere particularly quickly. But if we do get a big divergence from the forecast, then you could see a much more outsized market reaction than you typically would. So, of course, do bear that in mind when the non-farm payrolls number comes around on Friday lunchtime. In terms of expectations for the print, headline non-farm payrolls seem rising 190,000 in the month of June. That would be down from the 272,000 that we saw in May, and below both the three-month average at 249,000 and the break-even payrolls rate, which sits around 250,000. Of course, that is the rate of payrolls growth required for job gains to keep up with an increase in the size of the labour market. Now, some of the leading indicators for the jobs report are a little bit mixed. Of course, we haven't yet had the latest PMI data. The ISM manufacturing PMI is out in about 40 minutes, just after we finish recording, and the services data due on Wednesday. But the continuing claims number is a little bit worrying, having risen last week to its highest level since November of 2021. And of course, that data referencing the establishment survey week for the non-farm payrolls number. In terms of other areas of the report, unemployment expected to hold steady at 4%, although participation is set to tick slightly higher to 62.6 from a prior 62.5%. Meanwhile, average hourly earnings expected to rise by 0.3% on the month, and that should drag the annual pace of earnings growth down to 3.9% from a prior 4.1%. Now, in terms of the policy implications of the payrolls report, I think we're once again dealing with a situation where they are likely to be relatively limited. Of course, if you think back to Chair Powell's remarks at the June FOMC press conference, again, the Fed was saying that they would respond only to unexpected labour market weakness, i.e. labour market weakness that is more or to a greater degree than in the latest forecast outlined in the summary of economic projections. So long as we get data in line with the market expectations, it's set to remain inflation that remains the key driver of when the Fed deliver that first rate cut. And of course, we had the core PCE deflator last week coming in at its lowest level since April of 2021 on an annual basis, and at its lowest level since November of 2020 on a month-on-month basis, which, and I know, Ryan, you might not agree with this, leaves September on the cards for me as the first rate cut.
Yeah, well, I'm hoping that we get some volatile data, because I think that thinner liquidity could give us some good price moves for once. I've had enough of 30 pip price moves of NFPs. I remember the days when it used to move 200-300 points on a big number. So I'm hoping for a little bit of that.
Albert has joined us during the war and all that.
During the war, yeah, it's.
You've got the hair, you just need the beard.
Yeah, that would have been the Gulf War, by the way. Yeah, I'm hoping we get some volatility. Otherwise, it's going to be a damp squib to the end of the week, and we don't want that for our trading. It's double bubble with the Canadian jobs as well. Numbers-wise, we have the same conversation month after month. If it's around that plus 100, anywhere 200, 300, market's not going to be that bothered about it. Wages is one of my key metrics. We've been glued around this 4% mark forever. So unless we get a big variation difference either side for that one, it's going to pass by under the bridge pretty quietly. And obviously, when you're talking about the unemployment rate, then obviously, as usual, keep an eye on that participation rate to see if it's dragged the unemployment rate one way or another, because it can be a bit of a double positive or double negative or a neutral number on that. But yeah, fingers crossed for some volatility.
Yes, indeed. I don't share those hopes, but I can understand exactly where you're coming from. Of course, before we get to the payrolls number, we've got the small matter of inflation due out of the Eurozone. Well, when you watch this, in around about 2 hours' time after this goes live.
Yeah, so hopefully you get this before the data's released.
I've got to hope Kyriakos pulls his finger out and gets this done.
Kyriakos, you got a job on your hands, mate. Or this segment's pretty redundant. But yeah, after spending several months or a couple of months at 2.4%, inflation rose in the Eurozone back to 2.6%, while the core went back to 2.9 from 2.7 after dropping to 2.7 from 2.9 in April. All of that justifying the ECB's decision for the June cut, but then a wait and see approach from there. ECB doves look like they may be waiting a bit longer for their next cut on the back of that, unless we get a big drop this week. Now, we're only expecting to see a drop to 2.5% in the headline CPI and 2.8% in the core. That's down from 2.9%. So only 1 pip drops in both those metrics. As usual, any bigger variation is going to see the pricing for the next cut change along the calendar. If it's much lower than expected, we'll see maybe some June pricing increasing for that month for the ECB. But as another cut is highly unlikely then anyway, and then Lagarde and a flock will disappear on their summer holidays, we'll really be seeing if September or October become in the frame on a lower print. If we see hotter numbers, then I can see the Louis Vuitton suitcases will be packed and a cab to the airport will be waiting outside ECB HQ as soon as the last
Who
question.
writes this stuff for you?
As soon as the last question has been asked on the July presser, which will probably be on climate anyway. Of course, the suntanned one will break up a holiday, probably pop over to Jackson's Hole in August for the annual central bank shindig. I'm afraid we'll sail off into the summer. But for trading this data, once again, just take it in the context of trading the long-held ranges and matching it off against whatever is going on elsewhere, like in the US.
Yeah, absolutely. I think that's certainly the best way to go around trading the data. I mean, in terms of the release itself, I don't think it's going to alter the policy outlook too significantly. I mean, we all know that the ECB aren't going to do anything in July. I think only the most dovish members of the governing council are saying that they should pull back-to-back cuts, and even then, those remarks are heavily caveated. Of course, the other thing to bear in mind with the ECB, and before they do pack those Louis Vuitton suitcases and disappear off to the south of France or God knows wherever else they're going, and where Lagarde's moving her sun lounger this summer, of course, the other thing to bear in mind is that they are holding their annual conference in Sintra this week, which is like a sort of Thomas Cook version of Jackson Hole, I suppose. And we will see whether we get any significant remarks on policy there. But of course, most of what we're hearing from the ECB these days is very much in line with the Fed in terms of, we're data dependent. Further cuts are probably on the horizon, but we're not going to pre-commit to any sort of path. And actually, why would they at this point? I think most policymakers in Europe, we do joke about it, but they're 3 weeks away from their summer holiday. You're not going to want to rock the boat before then because you're going to have an absolute mess to clear up while you're trying to put your feet up. So I think very much as you were in terms of the inflation side of things and the policy side of things in Europe at the moment. And really the market's primary focus is going to remain on that political risk that you discussed earlier on.
Yeah, I think so. I mean, the numbers that we've had out from various Eurozone countries, CPI flash numbers so far, indicate that they should be bang on the money in terms of what's expected tomorrow. But you never know. It's always the times you don't expect it when something comes along and kicks you up the backside. So maybe we'll get, again, some more spicy data to get our trading teeth stuck into.
Indeed. And that is, of course, very, very true. Right, let's move on to That's the Setup. Right, now I know Ryan is our resident Japan correspondent here on the Trade Off, but I've taken up his posting in Tokyo this week because...
I nicked my headline, I should say.
Yes, and I've stolen your headline, which I still think is one that I came up with, but we'll let sleeping dogs lie on that one, I suppose. Right, what do I want to talk about? I want to talk about the yen, because everyone seems to be getting all over excitable and bubbly again about the prospect that the Ministry of Finance are going to intervene in the yen to prop up the value of the currency amid the continued weakness that we're seeing. Of course, dollar yen traded north of the 161 figure last week to its highest level since 1986. That is, of course, a 38-year low for the yen, for those of you who are counting. Now, I also just wanted to share this chart because it took me about an hour to code up this indicator in Bloomberg, which is an embarrassingly long amount of time. But the reason why I spend that much time on it is because the Ministry of Finance in Japan are watching a lot more than just where spot dollar yen is trading when it comes to determining whether or not they should step in. Because, of course, remember, two of the things that the Ministry of Finance love to focus on is whether the moves are speculative in nature or whether they're in line with the underlying fundamentals underpinning the pair, and whether they're becoming one-sided or whether there is good two-way action in the pair. Now, of course, there are a few ways in which we can gauge this. If you look at implied volatility, for example, well, it hasn't moved. 1 week dollar yen implieds continue to trade around 9%, which is in the bottom 25th percentile of the 1 year range. And if you then look at realized volatility, perhaps one of the easiest ways, albeit a little bit crude, to gauge this is to look at where spot dollar yen is currently trading compared to the 30-day low. That gives you a rough idea of how rapid the weakness is that we are seeing. Now, you can see I've circled on this bottom pane of the chart there the last two times that the Ministry of Finance decided to intervene. We saw roughly a 10 yen move from low to high before the Ministry of Finance stepped in. This time around, we're only at 6 yen above the 30-day low. Now, of course, this is not to say that the Ministry of Finance won't step in as soon as I finish talking to try and prop up the value of the currency, because, of course, the only people who know exactly what they are going to do is Kanda and his friends on the Ministry of Finance trading desk, although, of course, he's being replaced towards the tail end of this month. But nevertheless, this relatively crude analysis suggests that as long as the move is relatively slow and relatively controlled, we could get perhaps to 163 or even to 164 in dollar yen before they step in. Although, of course, that is a rolling target given when the 30-day low falls out of the data. But the overarching focus is that it is the speed of the move in the yen that is what the Ministry of Finance are primarily focusing on, not necessarily the fact that we're trading at 161 or 162 or wherever it may be.
Yeah, I'm just keeping an eye on dollar yen as we speak, just in case they intervene while you're talking.
I was going to say, here we go. When I haven't got a screen in front of me, you know.
Yeah, we're just tapping up against 161.45, so we are continuing going. I'm going to take a different slightly approach. I think we are really, really close to intervention mode, purely on the back of what Kanda said last week. He said these moves are speculative. It was really, DEFCON bingo, if you like, or jawboning bingo with the comments that he went over. The only thing he held off saying was that these moves are excessive. If he'd have dropped that line in, then I think we are pretty close. But you're right what you say. You summed it up well. It's the speed we go. You know, if we shoot up 300-400 pips this week pretty quickly in a couple of sessions' time, then we're right in the zone. But I think we're pretty close at the moment, and it'd be interesting to watch your graphic there. Are you going to patent it and flog it as an indicator to the rest of us?
I really don't think it has any predictive power worth selling it for, apart from maybe the price of a pint. If anyone wants to come to the City of London, I'll happily share the code for it with you.
Oh, well, if it's that green line at the top and then they intervene, then I'll definitely buy it off you for a price of a pint.
If it is, I will be amazed. And the first thing I'll do is go and put buy a lottery ticket for next weekend, I think.
Yeah, but I think the important thing we have to think of now is if they intervene, what happens after? I'm inclined to look at potentially, buying a dip on intervention, because if they keep it to the same line as they're just going to kick out the speculators a little bit and slow things down. They can't stop the tide entirely. The only risk is if they just take a different tack, different approach. Maybe they intervene for a couple of days on the trot, really give it a good hit. I'll come out with some other comments as to why they might continue to intervene. So we have to watch what happens right after. So be careful should we see that intervention. Any comments that come later on from that, and obviously they won't say what they've done until it's all under the bridge. So just be careful.
Yeah, absolutely. And I think not just any comments, but also if there are comments, because last time around they didn't say anything and they just kind of left us to our own assumptions for quite some time, until, of course, we got the monthly intervention data, which comes, well, it won't come until the end of July, of course. In any case, let's move on. I mean, you're talking about South Africa and political stability. Are you okay?
Yeah, I'm okay. It depends on the context, really. This is political stability for at least the next 5 minutes, I think. So that's as good as you're going to get in South Africa. But yeah, we've got a bit of stability. Ramaphosa's finally put together this cabinet together to form this national unity government. That happened in the early hours of Monday here. The rand has responded by gaining a little bit, did put it back below the 1810 level for a while, and even got under the 18 level, but it's back as above that at the moment. The 1810 was support on Friday. It was resistance this morning. We're back above again today, so that's really your sort of pivot level to look at the moment. The worry for investors and traders now is how long will this new unity government last before the infighting starts and the wheels come off, and how much will they actually achieve while in power? I suspect it's not going to take long before the old problems that have been plaguing South Africa before the elections start to be front page news again. That's things like infrastructure issues related to things like power outages. And so I don't think any positivity that we're seeing now is going to last too long for South Africa, the rand or any assets. Technically, dollar rand has been relatively stable, though, in this sort of 1939 range. but this positivity may have a bit more to run in the short term. So a move down to that 38.2 fib is a possibility. If we get back below 18 and start to hold below it, that's when I think we're going to move down to that fib level. That fib is where I'll potentially look to go long again, depending on the news driving it there. Obviously, with the Fed cut timeline still an uncertainty, I'll need to monitor whatever moves are happening in the dollar as well as the rand, and whether they're related before making any trading decisions. So a bit of positivity for now, but let's see how long it lasts.
Good stuff. I'm going to be completely honest and tell you that I've got absolutely no information of any value that I can add with regards to the rand. So I guess the best thing is that, what are you shaking your head for?
Oh, you're supposed to be the expert on this show, on this shindig. You know,
not on the random emerging markets that you keep throwing me. I mean, you're throwing me the emerging market of the UK in a minute as well.
Oh, I don't know. You're the economic expert. I'm just here to make it look good.
Are you?
Oh, so that's what I thought I was doing anyway.
Well, I'm not sure you do that very well. Right.
Moving on.
Indeed. Let's move on. I want to talk about French equities because we saw a decent bounce in CAC futures at the European Open around about 7 o'clock this morning, of course, Monday morning. The market trading as much as 3% higher at one point, although we have paired those gains somewhat. And of course, this is after the election results and the initial exit polling from the French election over the weekend have cast some doubt on the ability for Marine Le Pen and her friends to form a majority government in France. Now, this has taken the front-month future briefly back above 7,700 and north of the 200-day moving average once more. And of course, a couple of weeks ago on the show, we brought this up and I was talking about how actually I like the idea of buying the dip. I still like being long risk more broadly, and actually think that, or thought I should say, that this move towards 7,500 was one where the bulls should be getting involved. Now, I still like being long risk and I still like the idea of buying the dip, but I think it's important to recognize that we are 200 points above those lows. And I don't think that the market is entirely out of the woods at this moment in time. Of course, we discussed the risks a moment ago that the second round coming up on Sunday results in either a hung parliament or a complete stalemate or even a majority for Marine Le Pen, which of course the market is now pricing in a much, much lower risk of. So I think for those who have been long, it is perhaps worth taking a little bit of risk off the table, and that's certainly what I would be looking to do now that we've traded up to these highs and had this gap higher. But that said, if we were to get another move lower and we were to get another retest of this 7,500 region, then that is again and still a dip that I would be looking to buy. But I think this is one of those where, given the uncertainty surrounding the market, don't get greedy, don't get too overexcited. Take the profit if you're in profit, take the risk off the table, and then reassess things this time next week when the outlook becomes a little bit less murky and a little bit clearer.
Yeah, wise words indeed. You never go broke taking money off the table, sure thing. I think we've spoken about this. It really is a bit of a messy one. I don't know how the long term plays out in this, and if it is a mess, then I can see French stocks just grinding lower until we get some sort of stability there. I think one item you want to look at if you're looking at trading anything in France is look at those French-German spreads. As we said earlier, they've blown out to the highest since 2017. But this isn't a Eurozone problem. Last time we get spreads blowing out was when all the spreads were blown out versus Germany because there was an existential problem, potential problem to the Eurozone. This is single country, so these spreads, if they narrow down a bit, that's going to show the markets getting a bit of confidence, and that will translate into seeing the buying of French assets like French stocks. So if you want a secondary view of what's happening in France, keep an eye on those French-German spreads.
Yes, absolutely. And it is worth noting that the OAT Bund spread has come in about 10 basis points this morning and into this afternoon. We were trading up at, I think, 83, 84 basis points at the wides on Friday, with that back down to about 73 basis points now. So that is, of course, just a sign that the market is perhaps pricing out a little bit more risk. Now, more election commentary, but this time in the UK. We've done a bit of a roles reversed in this segment.
I know you'll be telling me off now if we talk about the elections again. Just wait till we get to
I'm going to bring it up again after you. So.
Oh, good. And then, of course, later on we've got the US elections to get our teeth stuck into. But we'll probably still be wondering what France is doing by then as well. Yes, we are heavy on the election stuff today, but we're all here to trade the themes du jour. So if opportunities arise, we want to know what they are and where they might present themselves. So in this case, as Michael suggests, the fallout from France may not be over. And so if investors are going to exit further out of French assets, they'll want to find a new home. That will likely mean dispersion into other Eurozone stocks, Spain and Italy and Germany benefiting, though with the German economy looking worse and worse day by day, I don't know why any money would want to go wandering into there. So step up the UK. We've seen outperformance in UK over the last few months as well. Excuse me. So if we do get a strong majority government here in the UK after Thursday's election, and one that's a bit more centrist, left-leaning than some seen in Europe, investors may be interested to shift some money over here to the UK, which then could be a good tailwind for UK stocks. For that, I'm looking at the FTSE All-share, which is has a bit more broader UK-centric index than the FTSE 100 on its own. So even without any flows from France, excuse me, a stable political situation in the UK would likely be market positive anyway, although expectations are leaning that way already. We've previously had a decent break of the 4,400 level, and I'd consider buying a dip into that level if it's seen before the UK goes to the polls. From there, I'd be watching to see if we can retest the highs, the prior highs up in those 46s. I'd likely be wrong if we're back below 4,400 and even more so, excuse me, if we're below that 38.2 fib at 43.47. So there's two places identified there for possible stop loss points.
Good stuff. Yes, I like the trade. I think there's some very clearly defined levels around it as well, with which one can use to manage that position. And I'm glad you brought up the FTSE All-share. You can do the same thing with the FTSE 250. The FTSE 100, actually, in a similar way to the CAC, which we were just talking about, is not really representative of the UK economy. The vast majority of firms operate listed in both indices, generate the vast bulk of their revenues from overseas. So it is those smaller and mid-cap indices which may perhaps see the most upside on any potential electoral optimism, but equally perhaps face the most risk if we were to get a surprise from that exit poll on Thursday evening. In any case, let's move on to our plays of the day. Right, well, I'm kicking things off with the euro. And of course, this is something that I know Ryan has been looking at for quite some time now, this 85 figure in euro sterling. And I'm looking at it myself this week as well, because I think short euro sterling, in contrast to the last decade, probably, is starting to look like a bit of a political stability spread trade. Of course, here in the UK, we're about to elect a Labour government, likely with a sizable majority, probably putting Keir Starmer in power for certainly the next 5 years, if not the next 10. Whereas on the other side of the channel, you've got political uncertainty in France, but you've also got things bubbling up all over the place. Germany, we saw a rightward shift in the European Parliament elections, and they head to the polls late next year. Holland, Austria, seeing the same thing. Italy, of course, is effectively a political basket case. It always has been. It probably always will be. And with the cross beginning to retest this 85 figure to the upside, I like the look of selling into what has been a very, very modest recent rally to get the week underway. There are a couple of levels to the upside where you can place a stop. The 100-day moving average around 85.35 looks like a decent enough level to do so for me. And of course, the initial target would be the recent lows around the 84 figure. Although, of course, if we were to make a closing break of that level, we would be into not necessarily uncharted territory, but territory where spot hasn't traded since all the way back in 2022. Now, the risk, of course, here is what's on the bottom pane of this chart, and that is yield spreads, the spread between the 2-year Schatz yield in Germany and the 2-year gilt yield here in the UK. That points to euro sterling trading closer to 87, if not 87.5, than it does the 84 figure that I'm targeting here. Although the market has rather ignored yield spreads since all the way back in January or February, and I would expect it to continue doing so for now. So short euro sterling is my play of the day this week. Ryan, what are you looking at?
Yeah, well, firstly, I applaud you for going old school and calling Netherlands Holland like back in the day.
Who have I offended now?
Well, you've teed off everyone in Holland or
and
the
Italy
Netherlands
as well,
now.
probably.
Yeah, so more letters in the mailbox coming your way, no doubt.
I
Anyway,
need to appoint a secretary to handle my post.
Or proofreader.
It's not fan mail.
Exactly. It'll keep you warm in the winter anyway if you have to burn it. Anyway, I'm looking at 2-year notes from our play of the day. And I'm looking for the data this week to bring some much needed volatility. And I'm looking to trade these twos again on any decent US data. Once again, I'm looking for yields to rise on any good data to get longs on the price. From a yield perspective, 2 years up over 5% will look very attractive. This is purely playing the fact that the Fed are really adamant about not hiking again, as well as seeing some of the other data from other sectors not looking too rosy. On last week's show, for example, I previewed the potential for wobbles in the US housing market, and all the housing numbers last week came in worse after that. So I think it's maybe a matter of time before the Fed starts to see some worryingly weaker data. So any rally in yields on good data this week, I think might be fleeting. So anyway, 2 years down to that 101.10, 101.00 area will be where I'll have my fishing rod with a view to pick up some longs. My paying threshold will be through the 130 low. You can see on the chart there. So long if we get a rally on yields up towards 5% or over.
Good stuff. Well, you've got a couple of weeks to go fishing, Ryan, because that does bring us to the end of another show. And of course, we are not here with an episode of the Trade-Off next week because I'm taking the liberty.
Hold on. Yes, you're not here. You're not here. I'm here. You're not here. Don't say we're not here. You're not here.
I'm not here. Don't worry. Ryan takes holiday and does the Trade-Off even when he's away. I am not doing that, because I'm clearly not as, you're just a better man than me, mate. I'm happy to hold my hands up and admit that. So Ryan will be sat in this room with his green screen on his own for an hour next week, not recording anything. And our next proper episode of the Trade-Off will be in 2 weeks' time. So we'll be back with you on YouTube on the 16th of July. In the meantime, there are a very good couple of trading weeks ahead. Thanks very much, as always, for watching. And thanks, of course, also to the most committed man in FX, Ryan Littlestone from Forex Flow Live and Forex Analytics, for joining me. And we will see you in a couple of weeks' time. Thanks again, and goodbye.